All right, we'll get underway then. Thanks, Kelly and Nathan, for joining us. And people have asked for a copy as well, so we'll just record it. And so this week, we just thought we'd keep going with some of the themes we've been talking about through the COVID-19. And we've touched upon superannuation. And this week, we thought we'd just extend that conversation or Q&A into the share market. It's sort of popular at the moment. I was reading some information on the weekend, how the strong growth in, I suppose, DIY type investors out of the States and in Australia as well. They're opening up CommSec accounts or whatever, online trading platforms. And so I thought it was quite topical, and just go through some information and open up for questions in relation to stock markets, share markets, and where things are at. So I'll hand over to Andrew. He's got a few slides to work through, and then got a few questions.
I'll run through it. I'm sort of not sure exactly what was wanted to be discussed today, so I just sort of thought I'd go through. I might just open up. There's a couple of questions that came during the week, and one of the questions was quite interesting. How are managed funds different from stocks from a tax perspective, and what are the pros and cons to holding stock market investments in a personal or a company or a trust name? So I sort of have addressed that to a degree, but given that it's very much individual on individual's tax profile, I thought Will Michael sort of give his perspective on that.
Why don't we do that at the end, maybe? Just part of the wrap up, and just sort of go through some other material first.
That's right. So what I might go through now, there's a plethora of online tools that you can access, but traditionally, for buying stocks, you would normally go through obviously a stockbroker traditionally, or there's I suppose the financial institutions' versions of their online stock trading tools. For example, E-Trade, CommSec, NabTrade. Where you can go and purchase shares directly with their platforms. So they're probably, in my view, probably the first port of call these days. We don't normally go straight to a share broker these days, which traditionally Tassie's been. There's a business in Launceston who's done that, but I'm thinking of
JB Weir and Shadforth, I suppose, have been the brokers in the past.
Done that in the past.
Yeah.
And they would normally put together a recommendation around a portfolio of investments and give you a recommendation what to purchase.
Yep.
They would often facilitate that. Or, in my view, sometimes some of the easier ways is you get the recommendation. So you've got the stocks that you're wanting to purchase, and you can go forward and purchase them yourself on your own tool. And depending on your circumstances, you might have a Macquarie account, for example, which is quite useful, can do all those transactions, or you might use your CommSec, E-Trade, or NabTrade.
Yep.
So why do we do that? It's just so we can actually, we use the stock exchange to bring together buyers and sellers to make sure that the trades are actioned and met within a timely manner, normally around about 3 days as well. So there's stocks and shares, there's different vehicles these days that you can purchase, and we might talk about that a little bit later. But generically, I'll just talk about shares at the moment.
I think that gives you access to anything listed on the ASX from an Australian perspective. I can't quite remember some of those online trading platforms. I think I've got a NabTrade account, and you can access some of the US shares, but I'm not sure.
Yeah,
if they're listed in New York, but we'll just concentrate to the ASX maybe today.
I suspect you have access there through some different vehicles. I'm not sure if you can buy direct shares through that, but you might have seen the access.
I can't quite remember.
So that's from going through a broker facility, or you can use a lot of tools now that don't really provide any advice around the stocks, but they'll facilitate the transactions for you as well.
So if you said, oh, I'd like to buy some CBH shares and you've got a CommSec account, then you just go on and just purchase them using that platform.
Yeah.
And they'll trade you, I can't remember what CommSec is, but it's normally $1 fee per transaction of $14, something like that.
Yeah. So generally, I thought the pricing's around per trade's around about $19.
Right. Yeah.
But different providers obviously have different volume discounts with that as well. So that's the other way to do it if you're not wanting to actually get advice around it. And normally that's more inexpensive than going through a broker, because if the broker's doing it for you, then they charge you for that service. I'll just jump onto here. I just wanted to reiterate from my view, I take a fairly conservative long-term view on any stock trading. To me, it's a 10-year exercise as a minimum. I don't sort of play in the space of buying, selling, and speculating. So often, if I've got a client who's looking at it, my philosophy is to hold for 10 years and to buy quality stocks. And from a personal perspective, I stay within a spectrum of shares that are well known, and we've got good research on as well on quality companies.
Yeah.
But in saying that, the stock market brings to the table lots of different types of shares and types of companies.
Yep.
And some are profitable and some are not. But so it then comes down to the due diligence that you do now on the research of those companies before you purchase them.
I suppose there's two styles of investors. Mm-hmm. One, what you described there, which is your philosophy as well, which is taking a long-term plan of quality stocks or quality companies at the end of the day that your research would show worth investing in. And then you have the other one is probably more the speculator, where you can do it within quality stocks, or even the old mining stocks, where you sort of some of the small caps or smaller companies that you might say are worth $1 a day, and not, that might be the next big thing. So you're sort of more speculative. And then you've got the other ones that are more like your day traders, I suppose. They go in very small increments to say, well, CBA shares are $59 at the start of trade. I'll buy it at $59 and sell it at $59.50. Sorry. Yeah, that's right. Make you 50 cents.
Yeah.
And do it volume like that, which is another method, but I suppose yourself is more about the long-term plan.
Yeah, I suppose I personally don't play in the supposedly technology-driven trading.
Yep.
Obviously, the new models can't really compete against that technology. And what I'm alluding to is the high-volume transactions that are done through various tools in trading platforms these days. So my view is, it's a more simplified view, but there's different tools that are available to people, and different platforms that you can access through different products, I suppose, that give you access to that type of technology.
Yep.
I normally go through broadly. I had a personal persuasion towards dividend-paying stocks in Australia. That's predominantly been the banks.
It has been in the past. Could have changed in the short term.
They're winding that back. And my view is, for international shares, I've always used a more specialist in that region who understands the market more clearly than I would. And that would come down to some sort of vehicle, from maybe a managed investment or managed portfolio that I use for a certain region.
Do you want to unpack managed investments a bit more, if you want?
Yeah. So we all understand that there's different structures out there that you're investing in, especially, I suppose, inside your superannuation. Historically, it's been more efficient to bring to market I suppose, a packaged up version of shares in a unit trust structure. And that's typically what we've known in the past as a managed fund. Now, managed funds are unitised, and when you buy into those managed funds, you purchase a unit in that trust, and also you purchase into any of the inherent tax consequences of that managed fund as well. Historically, they've been the vehicles that large organisations have brought to the table, and a lot of people invest that way, especially through the superannuation as well.
Yeah.
There's other vehicles that we can use that's similar to a similar packaging arrangement. We've talked about this exchange-traded funds, or ETFs, as they're commonly called.
They're recently popular. When I say recent, probably the last 5 years, has it sort of become more popular?
Very popular in the last 5 years, and they've evolved more broadly in the last 5 years, but I think they've been a bit longer than that. The other vehicle that is getting a lot of play at the moment is separately managed accounts as well, which is where you buy a model or a portfolio design, and that's typically bought in your name as such. Yeah, so it's not actually bought through a managed fund structure. That's getting a lot of, I suppose, use at the moment. It used to be around for high net wealth individuals, but now it's more the pricing and the accessibility of that is, if you've got $5,000, you can invest in these structures as well.
Yeah, so it's SMAs, is it the one?
Separately managed accounts, called SMAs. And then there's another version of that which gets a little bit confusing, but called a managed account.
Right.
But that comes down to an ownership arrangement and how that's owned through financial service licenses.
Yeah. Okay.
But effectively, what you're buying is a group of assets under a structure, and it then has different tax consequences depending on how that's been arranged.
And managed funds historically may have a range of classes underneath some of those as well. They might say, 60% of our assets go into the Australian stock market, as an example, 20% into the international, and 20% property or something like that. And that's the way you sort of hedge your bets, I suppose, or a balanced approach.
So normally it's a diversified, you can have a diversified managed fund. Typically we hear of the balanced fund. And mind you, there's quite different asset allocations across the industry with balanced funds, and it's often quite topical. But when we talk about a balanced fund, it's an investment that has around about 65 to 70% of the investments in growth style shares. And then you might have a defensive component as well, which might be fixed interest, government bonds, Australian bonds.
So it's a couple of new terms there you've introduced, growth and defensive, because that's something I've heard a lot in the industry, but maybe unpack that a bit more. So growth is typically your stocks, your shares?
Your stocks, your shares, your equities. We typically call them equities, and that could be your international shares or your Australian shares. So they're from a risk return perspective more riskier, but they tend to provide a better return over the longer term. Where we've always, when you're building a portfolio and you want to give a bit of a cushioning effect for clients, traditionally you've used a fixed interest component, cash, term deposits, government bonds, may use company bonds and different vehicles to provide a bit more of an insurance or cushioning for market volatility.
I suppose in my head, I'm just thinking about two types, I suppose, of investment in a broader sense. One is within the superannuation structure, and then one is outside of super. So if we take outside of super, if you want to have your own investment portfolio outside of super, then direct shares and having a CommSec account is an option.
As an option,
whereas within super, you really would need to go into a self-managed super fund environment to be able to have that similar level of autonomy compared to if you want to have your own super fund, having your own CommSec account and buying direct shares. Or is it SMA starting to crack into that bit more of that?
Yeah, so SMA is the actual vehicle, and it might have a list of different assets inside it.
Right.
You can there's still super funds here. I'm thinking typically one, for example, Australian Super, you can still purchase managed funds inside that, and they also provided access to some direct shares.
Yep.
So they're kind of what we call a mini wrap. You also have master trusts that have been popular in the past, and also wrap platforms that provide a broader brush of investments. So you can purchase direct shares through those as well.
Yeah. And when you talked about growth and defensive, that's probably more from a long-term plan. So I'm thinking once again, that's an asset allocation split so within super funds. So if you're coming up closer to retirement, you more like to have a more defensive pool, whereas if you're a younger person, you more like to have more of a growth emphasis as a generalisation.
Yeah.
Whereas within, say, if you're direct outside of super, then you probably balance it up. Say, okay, I own my family home, I invest in property, so I've got exposure to property through that, and then I want exposure to the share markets and other forms of investments outside of super. So you sort of self-balance yourself.
You self-balance, yeah. And that's why it's really important to have a look at the whole picture of your whole asset allocation. You might have cash in the bank or term deposits as well, and that forms part of that portfolio as well.
Yeah.
Okay. So same thing, just different tax players, I guess. One in your personal name or one through, I think the question was around companies and trusts, which can be done. Superannuation itself is a separate tax vehicle as well.
Yeah.
It has those concessional tax arrangements.
Yeah, so it's a tax rate of 15%, much lower than your personal rate, and that's why often you get tax strategies to put money into super, because it's a lower tax environment, and the downside is that obviously you can't access that until later on in life because before your retirement.
That's right. Yeah.
So just notice you've got direct shares in international markets. Maybe just explain a bit more Australian versus international and that part of the mix.
I suppose we can't get access to every type of industry in Australia. Where I think broadly, if you look at it, we're in the 2 to 3% of the world market in terms of industries. So if you're wanting to get access to big international companies, you need to go international. If you want to just invest in Australia, then you're limited on what you can invest in from that perspective.
So the one example that springs to mind from that would be something like the Magellan Group, which is a fund manager. So Hamish Douglas is the leader of that, and he's sort of been very strong in investing in technology stocks. So he's invested strongly into Alphabet, which is Google, into Microsoft, I think from memory. He's fairly heavily involved in Alibaba out of Chinese market, their online platform. So I suppose that gives a flavour of where if you want international exposure, and we don't have the technology stocks on the ASX, where you might say, okay, I want to be exposed to that market with your research or advisor, and that's a method of getting exposure to those types of investments.
Yeah, and it's also about I've got a view that you use the expert in that field to provide you advice on that, and with planning work and financial streams and investments that we do, we can't be everything to everyone.
Yeah.
So we need to partner with different providers who will provide that knowledge for our clients. And they're some of the vehicles that we use for all that. So getting international exposure, in my view, is needed, especially in this environment. We've seen a bit of I suppose, the cushioning effect of having international exposure, especially at this time in Australia. Money tends to flow in volatile times out of Australia to the US, and it has a bit of a cushioning impact on your investments. So
my reading, and I could be totally wrong here, would be Australia is probably internationally well placed through the COVID-19, and there's probably more question marks in my head about the US than what would have been historically, because US is the heart of capitalism, and so that's got a long history of the whole stock market, and being the birthplace of many industries. And I was reading something on the weekend that Warren Buffett, sort of the guru, he's got his hands in his pocket at the moment and sitting on $100 something billion of cash and not buying into the market, which is very unusual for him. And so the article was sort of saying, well, is he just unsure because it's a virus rather than an economic sort of impact? And so, it's interesting times.
I mean, people watch Warren Buffett very clearly to see what his next port of call is. I heard some commentators saying, has he lost his nerve? I'll have to. I think time will tell.
We're no experts in that field, but it's just interesting to observe where it's at the moment. And I think in relative terms, Australia's as an economic sort of situation, and they've got some pain to come. Internationally, I think we're pretty solid when you look at some of the issues around Europe and US.
Yeah, especially US. I think it's interesting times. So the next slide I just wanted to bring up is, this is a personal view I have, and obviously if clients are going through a discussion, their needs and objectives are really something that really dictates this. But I have a view personally that you should hold, if you're going to go direct and hold shares, especially in Australia, don't go crazy and buy 30, 40 shares. Buy 12 to 15, in my view. That gives you good, if it's well thought through, it gives you good exposure. If you're buying any more than that, it really brings to the table other vehicles that you could choose. Because especially you could argue that you're almost emulating an index funds approach by buying more shares.
Yeah, it was a good segue about index funds. I was just thinking we haven't described those as well, because we've talked about managed funds, which is probably more an active manager. Do you want to just describe what an index fund looks like?
So an index fund, and we typically probably think of probably the biggest sort of provider of that in the market is probably Vanguard. Their philosophy is to take an exposure across an indice or an index that emulates what's actually happening in the market. So when the market goes up, the index fund will go up. When it goes down, the index fund will go down. Whereas active managers back themselves a little bit further. They look at where they can purchase shares at value, and they try to mitigate risk through different vehicles. There is an argument that the index shares over the longer term adjust as perform as well as an active manager, or better. And I think the argument's pretty clear over a 20-year period. That's probably fairly true. It's, from my view, it comes down to the cushioning that you want. Do you want to go through lots of volatility, ups and downs of the market, or do you want to have I suppose a smoother progression over your investment journey? And that's where, in my view, active managers play a good role.
It's an interesting debate. It's been debated well and truly. And I think if you Google, I think Warren Buffett had a bet with one of the managed fund guys back in the 90s, early 90s or 80s, something. And that was the debate. So Buffett by himself, he's a very active trader. But he's saying if you're not up to speed with it all, it's more an index fund, as you say, is more of a conservative. And with Jack Bogle's, when he started index funds in the 50s and 60s, whatever, that was his sort of premise, that you just follow an index. So they might follow the ASX 200 as an index, and they just basically mirror that. And as you say, you'll go up and down with the market, but you're not going to have the star full forward in that team. It's just going to be the law of averages will prevail over the long term.
And the view is you're not making as many transactions, so there's not as many tax consequences, and so they're more tax efficient from that perspective. I suppose my personal opinion is a mix of type of assets. I'm not set on one style as such. When I look at portfolios, I have the clear winners in the active space that I like to use, and also broadly we'll bring to the table to reduce costs in portfolios using an index fund for some of those exposures as well. Because they inherently are cheaper than your active.
Yeah, their management fees typically lower because they're less active, I suppose.
Yeah,
they're not
as transactional, they're more of a long position.
Yeah, long term.
So that really comes down to, I suppose, a philosophy and how you see the world of investments and how you want to invest in terms of that. But they're all very valid vehicles. I wanted to go through today timing risk because this is a conversation I have a lot with clients, and because markets are fairly bumpy and we've gone through a pretty volatile period in the last 8 weeks, and it shows you how things can fluctuate. Looking at the returns in the market yesterday, especially in Australia, swung up by 2%.
Yeah, it was a bounce yesterday.
Bit of a bounce. How do you time that?
Yeah.
It's in my view, it's very, very difficult. I'm sure there's some people out there who feel that they can pick that. I'm not one of those. I take more of a conservative approach to that type of investment. So timing risk is important. So how do we manage that over time from an investment perspective? And the best way I feel is to do that is whether you're buying shares or if you're buying into a fund structure of some type, an index fund or a managed fund or a managed portfolio, you can buy at different time intervals. And the reason why you do that is that you're trying to buy in, so you're not making one poor decision, putting all your money at one time when the market dips.
Yep.
So you're trying to even out your purchases as you go in. We call that, I mean, the industry calls it dollar cost averaging.
Which I've never fully understood.
But the premise is that you just buy different increments over time. You might have a different value on that day when you purchase. It might be higher or lower. So in effect, that you're trying to buy the average over longer term.
So it might be a example off the top of my head. So it might be over a month. Say you might buy a parcel over a 3 or 4 week period, and effectively it's a weighted average you're looking for over that period, rather than me deciding as of today I'm going to buy CBA shares at whatever they are today, and then they tank for 3 weeks. I've sort of lost all my money, where I might put a third of it now, a third of it in a week, and a third of it in a month after that, or something like that.
And that's because we don't know what the market's going to do on any given day.
And is there rules of thumb under the dollar cost averaging about what those time intervals, or are they just the principle is that you just buy over a sequence of time?
Buy over a sequence of time. We kind of all do it anyway. If you think about super guarantee payments into superannuation, whether your employer pays that fortnightly or quarterly, if you're paying in on a fortnightly basis, that's the dollar cost averaging in. So I think superannuation is a great example of that from that perspective. I just put a comment here. When the market is falling, it's actually when dollar cost averaging actually works quite well, because no one knows when that rise and fall is going to occur. And it's possible to, at that point in time, as it falls, you're actually purchasing a discounted pricing point from my perspective. When the market's going up, it's not quite as effective, because as the market rises, the cost of when you enter increases as well. So you're not getting as much bang for your buck. So in volatile times like it is now, it's actually a really good time to invest, and that's where we've both noticed the amount of people who are interested in going in and doing a few speculative investments, because it is, at the moment, most people in the market are fairly well educated in terms of, we've gone through the GFC. Most people know when the low point is in the market. I've even got clients who are in their mid 80s who watch the ABC every night, and they watch Kohler and
Alan Kohler,
Alan Kohler
with the eyebrows.
and with the eyebrows. and they know the history of that as well as anyone. So people are educated these days, but I think typically at the moment we generally feel that the market is cheaper than it has been, especially since February and March. From that perspective. The other thing I wanted to talk about was imputation credits, and that's something I might sort of
we'll cover that another day.
Yeah, we're probably going a bit too long.
Yeah,
so it's probably
there are a couple of questions
here
sure. And a couple of questions.
So we'll pick that up
from the screen.
Pick that up later.
Do stage 2.
Yeah.
So Jonathan asked me a couple of questions. He couldn't join live, but he asked how are managed funds different from stock from a tax perspective? And you sort of touched upon it a bit before, that managed funds typically are a bit more active and you don't have any control over when they're buying and selling. So you may get some negative tax consequences that you don't have control over. Essentially, they'll give you an annual statement to say, here's the buys and sells, here's the capital gains.
That's right. So you buy into the inherent capital gains tax consequences.
That's right. And you buy a unit as of today, but that there might be a an actual liability because that particular share was purchased by that managed fund 3 years ago, and so there's this capital gain coming out here. So that's probably to answer Jonathan's question. That's the difference between if you're buying direct stock yourself, then the capital gain is purely relating to your particular investment, not inherent liabilities.
Correct. Yeah.
And just to refresh, so capital gain, most people invest in this way are not what you call active traders. So an active trader is someone who's buying, selling on a daily basis. So then you've got the 12-month, if you held a stock for longer than 12 months, then you get the general discount for 50%. So if you make $100 capital gain and you held long for 12 months, you'll pay income tax on $50. Which goes to Jonathan's second question, is he's talking about structures, about where to hold these investments. So we're talking about superannuation funds, such as self-managed and other forms. So that is a low tax environment with the caveat that you can't access those funds for a period. So then you've got, do I hold my own name, do I hold my company name, and do I hold my trust name? So let's talk about company. That's typically where you wouldn't hold assets that are playing for a long-term gain.
Yep.
Companies are good for trading activities, as in like business trading activities, not good for capital growth assets, which is what you're getting. You're planning to get a capital gain, doesn't have the benefits of personal or a trust. So then you go, okay, so personal is better for tax perspective than a company. Then you look at a trust. So a trust, the advantage of a trust is that when you do have capital gains or dividends, then you can what they call stream those to individuals. So at the end of the day, a trust, I'm talking about discretionary trust here, will get allocated to an individual and pay tax at the individual's rates. What it does mean that if you've got a partner or a family, then you can distribute that profit amongst family or other beneficiaries to a lower tax environment. Yeah. So just gives that flexibility compared to holding your own name. So hopefully that's answered Jonathan's question there about different tax structures to hold shares.
And to put a caveat on there, I tend to not answer that on an open forum, and that's why I sort of hand it off to you.
Yeah, that's right. I can answer tax questions.
Because of the individual's tax profile might vary from person to person and how they run.
Normal general advice forums are coming out now. All right, I might just see if Kelly and Nathan, have you got any questions you want answered? I'll try and unmute.
Can you hear me?
Yep, hear you, Kelly.
Right. So with a self-managed super fund, are there any, I'm weighing up at the moment whether or not it'll be a long-term view, obviously being a super fund, and there's a couple of members in there, but reinvestment rollover, should you take the money out and pay the tax, or just leave it to just continually roll over if it's a long-term
You're talking about like dividend reinvestment, stuff like
Yeah,
that?
dividend
Yeah.
investments.
I'm a believer in dividend reinvestment, that if you're playing a long-term game, then you just keep accumulating shares and not get the cash, but reinvesting into extra shares.
Yeah. Okay. Just rolling it over. Yeah.
That's my personal preference. I don't know, is that, what do you have a view on that? Or?
Yeah, I look at it whether you're accumulating or if you're in drawdown.
Yeah.
So I've got a different view. If you're in drawdown, does that
So drawdown like pension or that?
Correct.
Pension.
Yeah. But I agree with you from a wealth accumulator point of view.
And I suppose that was the debate at the last federal election, where Labor had a very clear view that they were going to strip out any franking credits as a refund to a lot of taxpayers or retirees, and that's where they come astray in terms of the electorate. But yeah, you're right. In retiree land, then obviously they're chasing shares or dividend streams from that. Whereas if you just accumulation phase, then
you're trying to go for growth.
Yeah, it's a growth strategy. Yeah.
So yeah.
Yep.
And it's kind of, in my view, it's kind of that same dollar cost averaging in, but
it's true.
You're reinvesting into your investments.
Yeah. Any other questions, Kelly?
Just on restrictions. So I'm a trader personally, but in a self-managed super fund, is there any differences between the two?
Not really. It's really, you'll just, so capital gains in a super fund is not quite as attractive. I think it's, you get a third discount, not 50% on capital gains. But yeah, really no differences, just apart from a lower tax environment of 15% compared to your own name.
Yeah. Great. Okay.
What about you, Nathan? You're just waiting for the share market to bounce back, or are you?
I'm all pretty clear, Mike. I'm kind of set, as you know, we went through setting up a trading account and so on. So just
you're our Macquarie example, actually. That was a marathon.
It was a marathon, and anyway, got there in the end. But yeah, so we're just playing around with that as we speak now. So it's just an opportune time to sit and get a bit of detail from you. So no, good.
Yeah, so that does remind me, I suppose, one of, going back to Jonathan's question about structures, they probably have, under our current regulations, setting up a trust versus, in terms of, say, opening an Macquarie account, setting it up in your own name versus a trust name versus super fund name, it's a bit more hassle to go through a trust environment. And bear in mind, super funds are effectively just a glorified trust. It's still a trust arrangement, just in a different tax environment.
That's right.
Yeah. All right. Well, if there's no other questions, we might sign off then. Thanks for tuning in.
Thanks, Mike.
It's been informative, and we've got part 2, haven't we? Imputation credits. And,
that's right. I didn't know how far we would go today. So.
Yeah, no, we've got some more material. So we'll do that in a couple of weeks' time as well.
Okay. Fantastic.
Excellent.
Thank you.
Thanks, guys.
Great. Thank you. Yeah. See you. Bye.
And we'll have an awkward moment to stop recording.